Welcome to The Explainer. Today we're going to pull back the curtain on something that promises financial freedom, but, can sometimes be a bit of a trap: the personal loan.
I mean, if you're juggling a bunch of high-interest debts, you've definitely seen the ads, right? They promise this simple, almost elegant solution to all your debt problems. But is it really a lifesaver? Or is it just a different kind of trap? That's what we're digging into today, what the lenders don't tell you. All right, so let's start where most of us do, with the marketing. Lenders, they've absolutely perfected this pitch that's super appealing. And really, it all comes down to one deceptively simple number. So get this. According to Bankrate, the average interest rate for a personal loan was sitting at around 12.25%. Now, on its own, that number might not sound like some amazing deal, but the real magic happens when you see what it's being compared to. And boom, here it is. This is the core appeal, right here. You put that personal loan rate next to the average credit card rate, which, let's be honest, is often way over 20%, and suddenly the savings look huge. This is the hook. This is what gets so many of us to lean in and listen. And the marketing doesn't stop there. It builds on this with the promise of just making everything simple. They sell you this idea of a totally hassle-free fix: one bill, a single lower monthly payment, and bam, cash in your account, sometimes the same day. And right there, that's the moment you should be thinking, okay, what's the catch? Because that central promise, that idea of a lower monthly payment, well, it often hides a really important trade-off. The real cost of the loan isn't always what you see up front. Which leads us to probably the most important question you need to ask yourself here. Just because the amount of money leaving your bank account every month is smaller, does that really mean you're saving money? Okay, so check this out, because this table really pulls back the curtain on the catch. We're looking at a hypothetical $15,000 loan with a 15% APR. Now, option B, it's got that really tempting lower monthly payment, right? Only $350. But look closer. To get that low payment, they've stretched the loan from 3 years all the way out to 5 years. And the result? This is the part they don't exactly put in the headline. You end up paying over $2,000 more in total interest. Yeah, that lower payment comes at a pretty steep price. So you gotta ask, why would a lender even structure a loan like that? Well, to get that, we need to really understand their goal. And here's a little spoiler alert for you. It might not be about saving you money. This is fascinating. Research from the Russell Sage Foundation found this huge and really costly misconception. Get this, almost 4 out of every 10 people think that a lender is legally obligated to give them the best rate they qualify for. That is just not true. It's a total myth. And here's a big reason why. This is a disclosure from LendingTree, one of those big loan comparison sites. It spells it out right there in black and white. They get paid by the very companies they're showing you. They're not a neutral party. They are absolutely part of the sales process. So what's the big takeaway here? You have to shift how you think about this. You have to see lenders as marketers. They're not your financial advisor. They are not acting in your best interest. They're sellers, and their main goal is to sell you their product, the loan. But it's not just about the math and the marketing. There's also this really powerful psychological trap that comes with these loans, one that can actually make a debt problem even worse down the road.
Yeah, economists have a term for this. It's called moral hazard. It's basically the idea that having a safety net can kind of paradoxically make you take bigger risks. So in this case, you use a loan to wipe your credit card balances clean, and suddenly you might feel like, hey, it's safe to start swiping those cards again. And this isn't just some abstract theory. That same study from Russell Sage, it found that just seeing the ads for these loans was enough to make people feel less worried about financial risk. It actually made them more likely to make risky financial choices. So the so-called solution was actually feeding the problem. Okay, so with all these hidden costs and these psychological traps, how in the world are you supposed to navigate all this? How do you make a decision that's actually truly in your own best interest?
Well, here's your playbook. This is how you become a savvy borrower. Number 1, calculate the total cost. Forget the monthly payment for a second. Focus on the total amount of interest you'll pay over the entire life of the loan. That is the real price tag. Number 2, question the motive. You got to remember, the lender is a marketer. Their goal is to sell you a loan, not necessarily the best one for you. Number 3, and this one's huge, address your habits. A loan just shuffles debt from one place to another. It doesn't solve the spending habits that got you there in the first place. You have to be honest with yourself.
And finally, number 4, shop around critically. Don't just look at the ads. Go and pre-qualify with multiple lenders, banks, credit unions, online guys, so you can compare the actual rates and fees you're being offered, not just the flashy advertised ones.
So, in the end, it really all boils down to this question. When you look at a loan offer, what are you seeing? Is it just a quick fix, or is it a strategic financial tool? The whole pitch is designed to look like that easy, quick fix. But a savvy borrower knows to look right past all that marketing hype and ask the real question, is this the right move for my long-term financial health?